Welcome to Tuesday.
Wonderful.
I was thinking we could have a rebound today, but it doesn't look like it, judging by futures. 30 minutes until the start of the cash trade. I'm Matt Miller.
I think you were trying for like a turnaround Tuesday thing. We're not there.
Yes, I was.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, what could be really just a minor win for Nvidia. The company gets permission from President Trump to sell some of its chips in China, but China doesn't want them.
Meanwhile, there's Apple. It's become this anti-AI stock. A lack of AI spending for the company turns into a feature, not a bug.
And a new twist in the Warner Brothers drama, Paramount launches a hostile takeover bid backed by banks, billionaires, and Saudi Arabia.
Yeah, I was going to say Middle Eastern sovereign wealth funds that are doubling the amount that the Ellison family is putting in. One of the stocks that I'm watching, you mentioned it, it's Nvidia. And Matt, you probably put it well. We're going to talk to Caroline Hyde about this in a moment. It's a win, but how big of a win if China is pushing back on H200s being able to be sold into the country?
Again.
So Nvidia is only up 0.5%. It was up higher. It was a 25% revenue that the Trump administration was insisting on taking via tariffs. But this maybe would give Nvidia a new revenue stream, but I mean, probably not if
China
they're not
has now warned on at least 3 occasions in the last year it does not want domestic companies buying these chips.
Correct.
All right, Home Depot issued a cautious preliminary guidance for next year, expecting comparable sales growth of only 2%. The housing outlook really weighing on earnings. Toll also didn't help yesterday when the luxury home builder gave a disappointing outlook.
Yeah, we're going to get into all those stories, Matt. Let's start with Nvidia. And for that, as I mentioned, we're joined by Bloomberg Tech co-host Caroline Hyde. Caroline, is Matt's caution warranted, the fact that maybe this isn't as big of a win for Nvidia as it seems on the surface?
I mean, he himself, Jensen Huang, has said at the moment there is 0% revenue coming from China, and as it seems, he cannot get them to purchase his chips, even if he's allowed to do so. There are so many ifs around this, because remember, when the H20s got sign-off, alongside some AMD chips as well, with a 15% cut going to the government, that was never signed into law. So it never occurred. The CFO told Bloomberg at the time that until it's signed off, they're unable to do this, and they're unable to send the 15% to the government. Will this get legal sign-off?
15%?
Now it's 25%.
25%.
Now, it was 15% for the H20s. H200 is going to be 25%. But then, as you say, is China going to buy any of this? Because this isn't the latest, greatest Blackwell. This isn't pushing towards Vera Rubin. This is based on Grace Hopper. This is based on last year's offering. And for that, that's like sort of telling the Chinese to go suck eggs. Overall, they are frustrated that they want access to the best kind of semiconductors. I'm speaking to people in the industry who are saying we are assessing how much prowess China has with its own use of chips they've already had access to, with their own Cameracon and others that are building at Huawei, and what they've been able to do to basically line up all those chips and get the interoperability and be able to ensure that they can train their own large language models. Many think that we are not thinking that they are as good as they actually really are underneath the hood here.
So does China have enough homegrown chip makers? Does it have enough domestic producers to be able to do what it would otherwise need Nvidia chips to do?
Not yet. And I think that is why you're hearing the government still have to push back, as we heard with the H20s, on their own businesses. Now, Alibaba and all the big tech giants would like access, even to the H20s, even if they aren't as sophisticated, because they just have so much insatiable demand. And so H200s are 10x what the capabilities of an H20 was, even if they are based on the previous Grace Hopper architecture. And so, yes, I think businesses would like to spend the money, but at the moment they're really being asked to focus in on their domestic offerings.
Yeah, if I were in China and the Chinese government advised me not to do something, I probably wouldn't do it. Caroline Hyde, thanks very much. Caroline Hyde, co-host Bloomberg Tech, that kicks off at 11. They'll be talking a lot more, you can bet, about this. Let's get to Home Depot. It delivered muted expectations for 2026. Another sign the housing market is not expected to rebound in the short term. Here with us is Bloomberg equities reporter Matthew Griffin, and this is just one more piece of bad news for the U.S. housing market.
Yes, Matt, this outlook from Home Depot Depot comparable sales up only as much as 2% next year. Really not what investors were hoping for. I mean, you think back just a few weeks ago, Home Depot cut their profit outlook for this year. Zoom out a little bit, maybe some puts and takes on the data, but the big picture here, mortgage rates for the 30-year still above 6%, housing prices really high, consumers facing high prices elsewhere, under a lot of pressure. That's weighed on Home Depot's stock this year, down 10% through yesterday, weighed on home builders. And again, this outlook showing investors maybe that these headwinds could be here to stay through next year. Few glimmers of hope yet. Even the luxury housing is having an issue. Toll Brothers yesterday reporting their earnings. Their median house, I think, is what, like $1 million? What does it say if they're also giving an outlook that disappointed? Yes. At a basic level, it shows that no one is immune. The real thing that investors are latching onto with Toll Brothers is their outlook for deliveries next year, which fell short of expectations. That stock down more than 5% in the pre-market. I think investors will be looking for whether weakness among luxury consumers continues. Luxury consumers have been strong spenders this year, propping up not just Toll Brothers stock, but the broader American economy. We are, of course, sifting through every earnings report and piece of economic data, looking for information on the health of the consumer. And I think investors are going to be laser focused in the days and weeks to come on whether this is an anomaly, weakness with one company, maybe a cautious outlook that there could be some upside to, or whether this is the start of a trend of weakness here. And we'll get another read with JOLTS data later today. Matt, thank you so much. That's Bloomberg's Matthew Griffin. Now from housing to something you might find in your pantry, Campbell stock is up pre-market after beating EPS estimates in the company's first quarter. It also announced that it would be buying a 49% stake in Rouse producer La Regina for $286 million. Key, it says Campbell's soup there, but it is just Campbell's now, right? I guess yes. Something about the data being fed in.
Campbell's, it's officially rebranded to drop the soup.
Right, so it's just Campbell's.
Because they make other stuff.
They do, indeed. Joining us now is Bloomberg consumer reporter Red Brown. So for this company that makes other stuff besides soup, what did we get from them?
Yeah, I think we got another kind of picture of the theme that's come up in earnings quite a bit of this K-shaped economy, right? So they talk about things where is weak, is things like SpaghettiOs are showing weakness. People aren't buying as many SpaghettiOs, but Rouse, which is this kind of like higher end tomato sauce, is doing well. That is kind of offsetting.
And pasta.
And pasta,
delicious
right?
Pasta.
And it is good stuff, right? So it is showing how the people at the top end of the K are doing quite well, are still shopping, offsetting some of those losses that they've had elsewhere in the business.
It's had a tough year. Campbell's is down 30% year to date. If you look over the last 5 years, it hasn't done much better. What's the problem with this company? Is it just the U.S. consumer? Because I thought these were sort of staples. These are things that you have to buy pretty much.
Yeah, no, I think it's probably some like structural issues with the company. They are kind of working through a pretty significant cost-saving program. So I usually think that kind of speaks to the fact that the company is trying to take some costs out of the business. Earnings, they did beat on earnings, but it is falling as well. So there is, some issues there, and maybe how the business is running. I'm seeing earnings fell around 13, 14%. So yeah, definitely still trying to like work through some more business aspects of the company, but I think when you have also the consumers pulling back in certain areas, that doesn't help as well.
Isn't there sometimes in this environment, though, when there is stress, that you get less people spending at restaurants and more spending at grocery stores? Are you seeing that at all, or is this Campbell show just like overall it's softness and people just aren't buying name brands?
No, that actually did come up in the commentary from the management, that they are seeing people shopping at grocery stores, eating in-house more, and that is helping the business somewhat. But the word they use, and I think it's kind of it's a good description of how people are, is intentional. People are being intentional with what they're buying. So yeah, you maybe not buying the SpaghettiOs, the pre-made thing. Maybe you are cooking more, like you're buying more raw ingredients to make something that's can stretch throughout the week, things like that. We're seeing a lot of different kind of consumer behaviors in this way to save just at the margin.
All right, Red, thanks very much for joining us on this. Red Brown talking to us about the Campbell's Company. Check on futures right now. You can see that we are down even after we dropped a little bit yesterday. So right now, futures off 1/10% on the S&P, double that on the NASDAQ. Let's get a look at some of the individual movers. on our radar, and activist investor Starboard has reportedly built a 5% stake in Clearwater Analytics. It wants the software firm to conduct a strategic review.
Meanwhile, Ares is climbing. It will be replacing Kellanova in the S&P 500. By the way, just a programming note, we're going to be speaking to the co-head of real estate for Ares in the next hour. That's Julie Solomon.
CVS issued 2026 revenue guidance that's below Wall Street's expectations as it navigates a turbulent retail environment and government scrutiny across the healthcare industry. You can see it hasn't hurt CVS shares, gaining almost 3%.
And even though all of their items are in like deodorant jail and shampoo jail, and I hate it. I just want to buy my stuff without unlocking it.
Come to Westchester, Danny Berger.
That's a great idea.
The metropolitan area.
You're so right. It's much more convenient to drive all the way to Westchester versus like ordering on Amazon. Will do. All right, coming up on the show, a billionaire, Middle East sovereign wealth funds, and the president's son-in-law. It's the backers of Paramount's hostile bid for Warner Brothers Discovery. We have the details coming up next. You're watching Bloomberg TV.
Let's get now to high interest. Look what's making headlines around the world. President Trump told Politico that Russia holds the upper hand in its war with Ukraine, citing Moscow's size and territorial gains. The president pressed Ukraine to start accepting things, and he criticized the ineffectiveness of European leaders, saying they, quote, talk too much and don't produce. Trump's comments come as the U.S. intensifies its efforts to forge a ceasefire between Russia and Ukraine. A lot of talk and not a lot of production there either. Traders around the world are suddenly rethinking the path for interest rates. Markets now expect almost no more cuts from the European Central Bank, and Australia and Japan may even hike rates again. In the U.S., expectations for future cuts are also fading. A single hawkish comment from an ECB official kicked off the shift as investors brace for tighter policy and wait for the Fed's decision tomorrow. And the famed Big Short investor Michael Burry says he's taken sizable positions in Fannie Mae and Freddie Mac and believes their long-delayed return to public markets is close. In a detailed blog post, he argues regulators need to ease capital rules and reduce the government's claim on the firms. He warns their common shares are, quote, worthless without those changes. Dani?
To another top story this morning, Matt, the Warner Brothers saga, and we now have the names behind Paramount's hostile takeover bid, and they're notable for as much as their size as well as their proximity to the president. Paramount's bid is backed by nearly $41 billion in commitments from investors that include Saudi Arabia's PIF, the Qatar Investment Authority, and Jared Kushner's Affinity Partners. Joining us now is Bloomberg Tech's Ed Ludlow. And then, Ed, when you kind of group them together, the Middle East sovereign wealth funds are committing $24 billion. Right. That is literally double the amount that the Ellisons are committing to this. Matt rightly pointed out to me that they don't necessarily get board seats, but that feels like a huge influence coming from these Middle Eastern sovereign wealth funds.
The headline is that the deal's packaged as an Ellison family-backed deal, but you're completely right. Across Saudi's Public Investment Fund and then the entities from Qatar Investment Authority and Abu Dhabi, that's the largest chunk of equity. And then you have the structure of Larry Ellison and Jared Kushner through his private equity firm, Affinity. But in reading the regulatory filings, you know, the Ellison part of it, particularly the Larry Ellison part of it, is backstop. It's guarantees on the equity portion, which, you know, in the simplest way of summarizing it, is done against Larry Ellison's personal balance sheet, right? His net wealth, which of course is, you know, a big chunk in Oracle stock and through other investments.
It's interesting that the president's son-in-law is so involved in this. He's done, obviously, a huge deal with the Saudis already in the takeover of EA Sports. Doesn't this look as though there are many people close to President Trump or who would like to, you know, have the blessing of President Trump on other issues, putting in a lot of money towards the purchase of an asset that controls CNN?
There are a number of players, Jared Kushner included, who are in close proximity to the administration and the president. The president in the last 24 hours has discussed both bids. And while, you know, the precursor of the Paramount Skydance $30 a share cash bid was him acknowledging the antitrust considerations. The president's now essentially saying that he will have some oversight of the process as well.
Ed, the other thing I think that sticks out is some of the overlap, is specifically with the Ellisons, to the American TikTok bid, too. What does it mean, or how should we view what the Ellisons are specifically doing with media, and media that is very core, either when it comes to brands or usage in the case of TikTok and what they're trying to build?
Yeah, the TikTok piece of it is interesting and difficult to understand. Like, the big picture of Bloomberg screen time coverage is that broadly across the media and entertainment industry, the biggest threat to a combined Netflix, Warner Brothers Discovery, or a combined Warner Brothers Discovery, Paramount, Skydance is YouTube, because they actually have a large market share, particularly in the United States, in the battle for eyeballs. But again, time spent is probably the metric by which the market now measures the success of these platforms, and TikTok is a factor. Remember that within the structure of the TikTok deals, there are both technology safeguards and split ownership models, which we've reported on, right? We broke the story on how that split is with both foreign investors and the Ellison family and other family offices as well.
I keep going back to a couple of things. Yesterday, Michael Wolff of Activate told us that the creative community is more in favor of the Paramount deal. And it reminds me of Lucas Shaw's interview with David Ellison, in which he repeatedly expressed his main goal being to make good movies, that he and his sister Megan have grown up, on Hollywood and want to create content that's not sort of AI-driven sequel slop. Is it true that, the West Coast is more behind the Ellison deal? Because they do also want to fire a lot of people, right?
I thought you guys were going to ask me about the debt package, and we get to talk about the future of Hollywood instead. I mean, the way that a lot of the media industry analysts look at this is HBO Max has a ginormous library of content that nobody watches. So Netflix and Warner Brothers Discovery combining HBO Max with the Netflix algorithm would put into the real world, it would put in front of consumers a valuable library of content. Both companies, Netflix and Paramount Skydance, are actually arguing that they have the better outcome and bid from an antitrust perspective, although clearly Netflix, from a sort of broad streaming standpoint, would take a bigger market share, which is what the president's talking about. Paramount Skydance, remember, the main technical difference is that its bid is for the whole enchilada. All of Paramount, all of Warner Brothers Discovery, including the cable networks, while Netflix only wants the studios and streaming platform with the plan to spin off and divest the legacy cable assets. I'm not answering your question, which is what does Hollywood and the West Coast want? They, again, I think would look to Netflix, the algorithmic benefit of what the platform on Netflix offers, if it was combined with the studio and existing library that Warner Brothers Discovery has. That is at least the answer that we've been getting on Bloomberg Tech from the media and entertainment specialists that we've had on.
Right, but I mean, movie theaters across the country, I think, rooting for Paramount, right? Because the idea that Netflix is going to let something play in the cinema is unlikely.
Because very quickly, Netflix's track record is to have a preference of releasing high caliber content on the platform first with very limited theatrical release. And in Lucas's detailed reporting through this saga, we aren't sure where Netflix really stands on that in their proposal in the bid. And I'm sure that is a question that the watchdogs will ask over the course of time.
We could spend a lot more time talking about this, and I'm sure you will on Bloomberg Tech. Kicks off at 11 with Ed Ludlow and Caroline Hyde. From AI to infrastructure stocks, Citi's Scott Chronert shares some of his top picks for 2026. We're going to get to them next. This is Open Interest.
Since 23, and many people deny it, has been a broadening of the rally, with other sectors sharing the stage with information technology and communication services. Any company that wants to keep a competitive edge needs AI. Any company that wants to gain a competitive edge needs AI. Any company that just wants to maintain a good premise as a value company to attract and maintain investor loyalty needs AI.
Oppenheimer's John Stolfus defending his 8100 call for the S&P 500 next year. Joining us now is Scott Chronert, Citi U.S. equity strategist and managing director. Scott, the bulls have come out for 2026, not just him. HSBC's Max Kettner writing this morning that he would be max bullish, max overweight going into 2026. Do you share the same enthusiasm for the new year?
Yeah, so I do. We haven't published our full year targets yet for 2026, so we're still in print for only mid-year. But what I would say, the narrative that we've been building recently does kind of play into this. We've been on this broadening theme for some time. Essentially, the argument here is that as we go into 2026, we think the fundamental broadening across different sectors within the S&P is going to be an important part of the playbook that's going to be in addition to the AI tailwinds that we're seeing in tech, okay? So essentially, as you think about next year, we're arguing a couple of things, Dani. One is that this Mag 7 Elite 8 construct becomes more idiosyncratic. We've seen that behavior already this year. But what that is offset with is more of a cyclical rotation going into next year on the heels of further Fed rate cuts, ongoing economic growth improvement into next year, and a little bit lessening of the policy consternation that we've been facing. So all told, we think the setup here is pretty constructive going into 2026. And that includes going down cap into U.S. small mid cap as well.
Into small cap as well. We were talking about the fact that the Fed is getting maybe a little bit more hawkish. Does that worry you?
No, I mean, the way this is setting up, Matt, is if you, I get it. The S&P valuation construct is a constant source of conversation. But if you step back and look at it, this is really interesting. The large cap growth part of U.S. equities is the only part where you've seen earnings expectations rise through the year to where we're looking at stronger earnings growth now than we started the year. Everything else, including down cap, is a different setup. And here's where it gets really interesting. You can buy the S&P 600, for an example, at a nearly 10 multiple turn discount to the S&P with a growth convergence dynamic that suggests, per consensus estimates, that earnings growth in the small cap space is going to be approach that of large cap next year.
All right, Scott, we'll get more into that. We got to get to the break so we can get to the market open. We'll continue the conversation. Scott Chronert of Citi, your opening bell is next.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. There's not a lot going on in futures. You can see we're pretty much unchanged here on the S&P futures. NASDAQ down 0.2%. We do have some pretty interesting bell ringers for you today. Starting over at the New York Stock Exchange, Jack Mallers, surrounded by a bunch of dudes wearing hoodies. He, of course, of Strike fame, ringing the bell for 21. His grandfather was the chairman of the board of the Chicago Board Options Trade, so of CBOT, which is pretty cool. And his dad was one of the biggest broker dealers in Chicago. I've interviewed him. Very interesting dude. Over at Walmart, incredibly interesting. I don't know who it is, but one of these people, maybe both of these people, are fleet drivers who have put in 3 million miles on the road, just chasing that long white line, accident-free. So Walmart has a couple of fleet drivers ringing the bell.
I didn't know that was humanly possible to drive 3 million miles.
Yeah, that's pretty impressive,
so
right?
It is really impressive. Also ironic because they're at the NASDAQ being like, we're at a tech company. So one day are the robots just going to be driving?
Yes, exactly. Eventually they'll be replaced by AVs.
Yeah,
right?
I don't think we'll be
by
celebrating their accident-free drives too. Okay, speaking of tech, I'm looking at Nvidia. It's turned around from the gains we saw pre-market to now losses down 1/3%. President Trump said, Nvidia, congrats. You can export your H200 chips to China. We'll take a $25 surcharge off the back of that. But to be clear, it's now weaker this morning. Matt, China, the surprise of all surprise, the FT reporting that China is saying, we're not necessarily going to just allow you to start buying this chip. You have to go through all of these different allowances. We have to give you approval. And China, of course, hasn't been so generous with allowing companies to buy American-made chips.
Right, and let's not forget that the Trump administration wants a 25% cut of these sales. Maybe China is also going to want to put its hand in the pot. Home Depot issued a cautious preliminary guidance for next year, expecting comp sales to grow just 2%. The housing outlook is weighing on earnings as high interest rates keep more Americans on the sidelines. And we also got disappointing earnings out of Toll Brothers, which is surprising because they make what are deemed luxury homes, and we thought that part of the market should be doing well, but also weak guidance from Toll. Let's get back right now to Scott Chronert. He's Citi's U.S. equity strategist and managing director. And you know, this kind of flies in the face of all the bullishness. The U.S. housing market has long been a problem, and it doesn't seem like even rate cuts from the Fed are going to help that much, because over the last year they've cut 75 basis points, and the U.S. 10-year is only down like 10 basis points. How do you expect the 10-year to be priced in 12 months' time, Scott?
Well, I think the way we're thinking about this, Matt, is that, you know, in our view, the Fed's path to policy neutral is the path that we're on right now. And getting to that point and lessening some of the restrictiveness is an important element of this. Now,
do you think the Fed is restrictive right now, that this is a restrictive rate for the U.S. economy?
They've been pretty clear on this. Now, the discussion on terms of where Fed neutral is open-ended, but many will say it's in that 3.5% range. So the starting point here is you need to get the Fed down to neutral. I think the consumption data, you know, would tell you that there's still a concern regarding the labor backdrop and aggregate spending that in our opinion, the Fed needs to respond to. So you've got the path lower for Fed funds rates. Now, the other side of this is inflation and the term premium you're going to place out to the 10-year. And there, we're of the view that inflation is in a fairly manageable position right now. So, you know, where the 10-year ends the year, obviously, is going to be probably around these current levels, 4.1 or so. But the path lower still is going to be tied to inflation and Fed funds. We think, generally speaking, you continue to see the rate complex move lower, which again speaks to and sets up for a cyclical rotation as we go into next year.
Speaking of cyclical rotation, Scott, commodities have been doing so well. The Bloomberg Commodity Index trading around a 2023 high. You could say it's maybe the economy, expectations of an uptake. Maybe it's the new economy with demand for different infrastructure. How are you viewing that, and how does that translate into some of the stocks that you like heading into 2026?
Yeah, so there's a big discussion out here in terms of what the drivers are of sort of the macro tailwinds that we're dealing with right now, and how much of that is a pull from the AI infrastructure build out. And I think that debate will be ongoing next year, but suffice it to say, we have had that as a tailwind. We think it, again, broadens down other paths as we go into next year, all of which sets up, we think, pretty constructively for this ongoing broadening thesis. So you step back and look at the way we've been positioning. Yeah, we've been overweight tech all year with a focus really on the semiconductor space and software as well. But within that, we've also been pushing out the cyclical path, whether it's financials. And so we're fairly keen on the banks here still, despite very strong performance this year. And then within the more traditional cyclicals, we've gotten more constructive on cap goods. And, you know, we've been using names like Rockwell and Quanta Services on our rec list for over a year now. And then even down the consumer path where, again, lower rates as a catalyst here and a still fairly healthy high-end consumer has kept us very constructive on some of your larger cap names, such as Walmart, which you highlighted a few minutes ago. You mentioned Rockwell. I see in your note that you guys have spent time with company management there. What did you take away from those meetings? You know, I mean, Rockwell conceptually is a pretty straightforward play here in terms of the automation backdrop. But, you know, what really investors are looking for are signs that the shorter-term order uptake is in pretty good shape, and that's what we're starting to pick up here. So you get a company that you go back 2 or 3 years ago was really struggling to keep up with the rest of the industrial sector. The short-term order pattern picks up, and boom, the stock has been much better so far this year. So, I mean, I think what investors are looking for in this industrial space is a tie to the AI infrastructure build-out, which has been a real point of differentiation within that component of industrials. But then also, are you beginning to see a more broadening in terms of the economic underpinnings that can further drive the fundamentals from here? It seems like it's falling in place.
Well, Scott, that's like you mentioned Walmart, too. Another one of these companies that people are pointing to is saying they're making great strides in their technology offering and how they're using AI. Emblematic of that, Matt was showing them ringing the bell at the NASDAQ. They've relisted onto the NASDAQ to say, hey, we're a tech company now. Scott, especially for a company like Walmart and any other of these staples, discretionary, really consumer companies trying to brand themselves as tech companies, how do you distinguish what is AI theater and what's real and what's a buy case?
You know, really good question. I'm not sure how much time we have to go into this, but this is an important thesis, right? So essentially, we think one of the storylines for next year is that we see a broadening away from the AI enablers and creators of this year and last year to AI users next year. So you begin to switch away from the discussion around the hyperscalers as an example towards the users of the technology that are improving their operations. And there's going to be a plethora of companies, every S&P company, you know, if it doesn't have an AI strategy by now, it will. And if you don't, you got investors questioning what's going on. My point here is, though, is that the opportunity structurally for U.S. equities is that you see more companies deploying AI in a way that lessens their historic earnings volatility. And as you do that, you can pay a higher current multiple for that and a higher terminal value. It's one of the reasons why I think Walmart trades more expensively than does Nvidia, which is showing much stronger earnings growth right now. So this notion of deploying technology to better improve even a traditionally low margin business like Walmart's is really, really critical to the way the large cap U.S. equity landscape is unfolding. I think it's going to be an ongoing important storyline for next year.
Yeah, it's so interesting. Scott, thank you for joining us. We're looking forward to continuing those conversations into the new year. Scott Chronert of Citi. A check on your equity market now. We are little changed in today's session. I mean, okay, we're unchanged. Even though breadth is good, it kind of feels like days where we're up, breadth is really bad. And if we're unchanged to the downside, breadth is good to the upside. Go figure. Apple doing pretty well in today's session, adding the most points to the S&P 500. Exxon, those shares are up 2.1%. They gave an updated cash flow estimate for 2026, and that exceeded expectations. CVS also in your winners, too. They also gave expectations for next year. That beat what the street had expected. Going over to the downside, Meta Platforms, they're not doing so well, down 1.3%. Nvidia, we've talked about this all morning. Are they going to be able to sell H200 chips into China? Trump says yes. China says not so fast. Microsoft, Broadcom, AutoZone also down. AutoZone had earnings which disappointed, down 5.6%. Looking at the sectors this morning, most of them are into the red into the green rather, despite an index that is little change. I pointed out Exxon. That's why you have energy at the top. Utilities also at the top. Again, commodities in general have done really, really well. At the bottom of the screen, you can see communication services is down there. I pointed out Meta was one of the big losers. So again, you have kind of safety plays, I guess, at the top. Energy, utilities, healthcare, that's really the only things that are lifting up the market this morning.
Yeah, a little bit of a defensive rally here. Yeah. Coming up, Nvidia gains approval to sell its H200 chips in China, but will that help earnings? Will they get any past Chinese regulators? We'll talk about this with Mandeep Singh next. This is Bloomberg Open Interest.
A look at the top calls this morning, the analyst action we're watching. First up, RBC upgrading Colgate Palm Olive. The firm says that the stock is now beaten down enough that expectations are realistic and it can consistently meet or beat forecasts through 2026. Growth looks more achievable even in a tough macro backdrop. Those shares up to 0.3%. Next up, Goldman Sachs downgrades Norwegian Cruise Line, warning that its heavy and fast-growing Caribbean capacity could outstrip demand and pressure 2026 expectations. That makes the risk-reward less attractive. Shares down 1.7%. Finally, Barclays opens coverage on 34 healthcare names. They lean bullish on drug distributors like Teva and Hims and Hers. The analysts also arguing that earnings still have room to beat despite rich valuations. Goldman also says that specialty pharma is shifting towards newer, faster-growing products. Matt.
Colgate-Palmolive, by the way, does use palm oil.
I know.
In some of its products.
How often in life, well, you probably say never in life very often, but like palm olive just doesn't, it's not there at the front of my mouth, you know? Oil is.
It's a tough one. For some reason, a lot of people have a tough time with that. All right, let's turn to tech now. President Trump is giving Nvidia permission to sell H200 AI chips to China in exchange for a 25%, I guess we'll call it a surcharge. Joining us now is Mandeep Singh, Bloomberg Intelligence Global Head of Technology Research. So this is interesting on a number of different levels. The export tax, I think, is where we should start. Is there any historic precedent for this kind of export tax?
Not that comes to mind, especially with technology companies. And look, in this case, I think they've had a lot of back and forth in terms of selling NVIDIA's chips to China. In one case, the U.S. government didn't want to sell it. Then the Chinese government stopped, the sale. So that's why you see such a muted reaction. But there is no doubt when you look at the numbers, I mean, even if it's less than a $50 billion market in terms of selling to China, for a company like Nvidia, it's huge. I mean, we're talking about maybe a 10 percentage point lift to their growth rate for next year if they're able to sell to China. And the reason I still feel companies over there want to buy Nvidia chips is because when it comes to training the LLMs, Nvidia still has a monopoly. Every provider, I mean, TPUs was the first time that Alphabet actually used their own chips for training. But other than Alphabet, everyone that we know of uses NVIDIA for training. So that's where I feel like even though the Chinese government may say no, they would still want their companies have access to NVIDIA chips just for training, even if they may use their own chips for inferencing.
Yeah, but is Jensen Huang really going to change his expectations for China sales to anything other than zero, even with this?
No, and they're prudent in being conservative because you don't want to, raise expectations and then having to cut it back. So he wants to beat and raise, and I get that. But look, you have to think about NVIDIA's customers as the LLM companies. The companies that are at the forefront of training these LLMs, at the forefront of scaling laws, because that's what drives the bulk of the compute. If we are talking about building gigawatt clusters, those are the customers NVIDIA wants to sell to, not to smaller enterprises. That's not going to move the needle for a company like NVIDIA, which is going to do $330 billion in revenue next year. So you want to find those large hyperscalers, and they are your model training companies. 3 of them are in China. So they want to be able to sell them their chips, the newest versions of that, or the one version behind the US current version that they're selling, and be able to do that on a recurring basis. And that's why that market is so lucrative.
So the Chinese government, even though they've repeatedly warned domestic companies not to buy these chips, you think they still want their big LLMs to train on them? There's really very few competitors for that purpose. Are they charging significant tariffs on the import of these chips? Are they taking kickbacks from this? How's that working?
Not that we know of in terms of NVIDIA having to pay anything to sell to that market. I mean, obviously, these chips are not their latest Blackwell chips, so I assume they're going to price it slightly lower than the latest Blackwell chip. Also, you have to remember, NVIDIA is selling systems. They're not selling individual chips.
This is the Grace Hopper thing.
They actually are building clusters of 100,000 chips that are connected through their own networking gear. So when those chips are getting smuggled to China through some other means, they're not able to sell networking business. Whereas if H200 is allowed, NVIDIA will be able to sell their networking gear as well, because at the end of the day, the way you do training is to build a cluster of 100,000 chips that are interconnected, and you are using that to manage a workload and split it across those 100,000 chips. That's how you do training. And that's where, smuggling those chips is not a good solution.
But the smuggling thing also introduces this confusion, because the Justice Department, the most recent story I think you're referring to, detains 2 men of Chinese nationality, saying that you've threatened our national security by bringing and smuggling in H200 chips. But those are the exact chips that the Trump administration just said that he'd allow China to buy. So, is it a national security threat or not to have these chips present in China?
Or does our national security have a price? 25%.
Clearly, national security-wise, I think we have had a lot of back and forth, and that is the biggest concern because at the end of these these models are very powerful, and we're learning more and more about possible cyber attacks, state-sponsored attacks using these LLM capabilities. So there is that element that the more frontier model you have as a country, then there is a lot that you can do with it. And that's the national security concern that keeps coming back, even though, we have had a few approvals in terms of selling these chips to China. Those concerns are not going away anytime soon.
Right. Well, let's not talk around Dani's point, right?
Yeah.
On the one hand, the Department of Justice is saying these H200 chips, if the Chinese get a hold of them, that represents a national security problem. On the other hand, the Trump administration is saying we're willing to let the Chinese have these H200 chips if they pay a 25% surcharge.
Yeah, well, we don't know what those two people were importing in addition to that. Yes, that's what's been reported, but there could be a lot more to the way they're going about it. And as I said, when you are selling a clustered, big cluster of Nvidia chips, these are big systems. You almost have to forklift them, to install an Nvidia training cluster. So what are you doing with small chips? You don't know the end use of that, and that's where the bigger concern is, as opposed to a big giant training cluster that Nvidia is selling to a customer in China.
Yeah, I was going to say, who knows the validity of this, but the Justice Department is saying they would use it against American interests. Mandeep, we're going to have to leave it there. Always so great to get you on. Mandeep Singh of Bloomberg Intelligence. Coming up on the show, Pepsi slims down. We discuss Elliott's role in the coming layoffs and plans to cut its product lineup by 20%. That's after the break on Bloomberg Open Interest.
By the way, Mandeep. This is Bloomberg Open Interest. Quick check on what's going on in stocks on this Tuesday morning. Not a lot. The S&P 500 actually up now 0.1%. And as Dani points out, the breadth is good. The NASDAQ is down 0.2%. Nvidia, I guess, is a weight here. You can see that Nvidia has turned red now, down 0.7%, even with the presidential allowance to sell some of its chips to China. Intel actually gaining 0.2%. Obviously, it's a much smaller company, so it doesn't cancel out the drag that is Nvidia. Netflix right now is completely unchanged, whereas Paramount Skydance is down about 2%. These moves don't really tell us much of anything, but they're two companies that are in the news. And Campbell's Soup and Pepsi are in the news as well. Campbell's right now down 1%. Actually, it's just called the Campbell's Company. I'm going to have that changed. It's just called the Campbell's Company. And because they make a ton of other stuff, like potato chips and goldfish and SpaghettiOs, as Red Brown was pointing out, Pepsi is going to make less stuff, fewer things, after an agreement that it reached, I guess.
SpaghettiOs is basically soup. Anyway, I don't want to debate about this because we need to get to the Pepsi story, Matt. They reached an agreement with Elliott. They'll cut 20% of their product lineup, and Bloomberg's Crystal C covers activist investors and joins us this time from London. Crystal, is this Elliott getting what it wants in Pepsi?
So this is a sort of agreement. It's not exactly an agreement. So Elliott is getting some of what they want. The company announced that they're cutting the product line, the product offering. They're cutting workforce, and they're putting out more aggressive growth projection. They're now saying that it's going to be 2 to 4% instead of what analysts was estimating, which is 2.7%. Elliott is not getting a board seat, so they're only getting some of what they want. But the overall operational improvement is definitely something Elliott had been pushing for.
So what do we know about slimming down in terms of the product offering? What are we no longer going to be able to buy from PepsiCo?
So we don't know a lot about that yet. The detail is yet to come out. We are also hearing from the company that says they will be downsizing product line as well as prices. So I think it's definitely in response to more kind of constrained customer kind of spending in the U.S., where people are less willing to spend, especially on brand name products, and switching more towards white label. So there are going to be definitely some of the products that people love and consume that will be gone, and we'll see what kind of campaign can bring them back.
All right. Good prediction. Crystal C there covers deals for us at Bloomberg right now. She's out in London. Coming up in the next hour, Empower's Marta Norton says it is time to rebalance your portfolio. Plus, Ares partner Julie Solomon walks us through their new real estate management program for 2,000 properties worldwide. And we'll talk to Tanger CEO Stephen Yalof. We are 30 minutes into this Tuesday. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Dani Berger. In just moments, we'll get the latest JOLTS jobs data. For now, it's an equity market that is still within 1% of all-time highs after falling yesterday as yields creeped ever so slightly higher as they do so globally. And Matt, I believe those JOLTS numbers just now crossing the terminal.
Yeah, we are starting to see them. 7,670,000 job openings. The job openings rate 4.6%, and the quits level at 2,941,000. For some context, and as you know, context changes everything.
Right here.
Michael McKee, Bloomberg's international economics and policy correspondent, joins us here on set. So, Mike, looking through these numbers, and they're just crossing the terminal. What do you see?
Well, the interesting thing about this, of course, is that we haven't had any of these numbers for months, and this is a sort of combination of September and October. I presume it's loading very slowly on the internet. I presume that the 7,670,000 job openings is end of November number, or end of October number, rather. So it is the most up to date, as I'm not sure what September would matter in there. But the thing that people are looking at is the difference between hirings and separations. And total separations, according to this, let's see here.
Hey, Mike, why don't I let you look through some of that? I just want to do a quick market reaction.
Little changed at 5.1 million. So it doesn't look like a lot of people were laid off. That's kind of the bottom line here, is we want to look at not necessarily in this case the number of job openings, but the number of hirings and the number of separations. And separations didn't change very much, because the question is this a low hiring environment? And that seems to be the case right now. And especially when you see job openings go up, you're looking at a lot of jobs that may not have been filled. The layoffs rate 1.2% and the quits rate 1.8%. So,
by the way, it's so weird to see no prior number. I look at the ECO screen. You can also type WECO if you want WECO and pick your flag. But typically in the prior column, there's a reading there. Is the reason that we don't have one because of the government shutdown?
Yes, because there is no prior reading. We're not getting actual data as a past data, or we are getting it, it looks like, for September, but it's included in this. So it doesn't show up as the prior yet. It'll take a while to get that into our database.
In terms of the market reaction, you're seeing some of the gains in treasuries turn into losses this morning. You're looking at treasury yields. They are a little changed, but before they were moving lower. Stocks, they're still at their session highs of this morning. There you go. There's what two-year yields look like. Stocks are still at their session highs. So treasuries don't like it. Equities do like it. But Mike, just to carry off of Matt's point, the fact that we don't have any of the prior data, that we haven't been getting a lot of data, does it make it that much harder just to understand what JOLTS is telling us at this moment, to interpret it?
Once you go under the hood, it gets a little bit easier, and I've just been able to do that. When you look at total job openings during the months of September and October, they went up in both months a little bit. So not a lot, but a little bit. But then you look at hires, and hiring went down in September and in October, and separations went up in September, went down in October. So it looks like there was very little movement overall once you average those things out, and that tells you that not a lot changed, which is going to make it interesting for the Fed to try to figure out exactly where the labor market is here. Now, one number everybody's been looking at was to see government separations.
Dude, separations sounds so clinical. Is that firings, or is that quits, or is it both?
It's all. It's firings, quits, layoffs, and we see government, federal government went up in September significantly. but then comes down again by half in October. So we expected a big jump in September because of the end of the fiscal year when all the people who had been fired by Doge stopped getting paid. And it looks like maybe we got some of that, but it's now come back some. So what that would tell you about what the November employment levels are is a little hard to figure out.
All right, it's very interesting to see the Treasury market react this way, and it just adds one more piece to the kind of hawkish bent that maybe we're picking up on today. Mike McKee, he's our international economics and policy correspondent, joining us here on set. Let's get now to Empower Chief Investment Strategist Marta Norton. And Marta, you know, just generally, the jobs market has been a concern. Maybe this assuages some of those concerns. We're still likely, I think it's a lock, right? A rate cut on Wednesday. How do you see this economy?
Well, I think it's interesting because in the absence of government data, a lot of the company announcements were taking center stage with layoffs and announcements of, reductions in their workforce. And I think this data, at least, was potentially one reason why we're seeing this reaction from two-year yields. It gives the suggestion that maybe the labor market isn't as weak as folks were beginning to think in absence of data. And so maybe we won't get as many cuts going forward. And in fact, that's already been priced out a bit. We're looking at 2 cuts over the course of 2026 rather than 3, at least from market projections. And so I think what people are coping with is this idea that maybe the labor market doesn't give them the stimulus that they had been hoping for over the long run when we look at cuts in 2026.
How much of what we've been seeing in the market, Marta, that is yields moving higher, equities in a very tight range, struggling to post gains, is about what you just said versus what's happening internationally? The expectations for ECB's ability to keep cutting have basically vanished. We're talking about hikes for Canada and for the BOJ. Yields in those nations trading near highs for the year. Marta, how much is just the international seeping into the domestic?
Well, it does seem, I know we want to think a lot about the U.S. in isolation, but the reality is that bond investors are global and they're looking globally. And it's an interesting juxtaposition where we are today versus where we were at the end of last year when we were watching other economies in a rate cutting cycle. And now that seems to have stopped a bit, where of course we know that there is tremendous pressure on the US, at least politically, to see lower rates. So we're really at a different point in a cycle perspective. I would argue that I think the data is still going to win out over political pressures, and that is reflected in expectations for rates. But you're right. I mean, we have to take into account what the landscape view is globally.
You've argued, speaking of cycles, that we're in an AI super cycle and still, in early innings, or I guess on the front nine, however you want to put it.
Yeah.
What do you think we're going to see in equities? Because we're getting so many bullish targets. John Stoltzfus out at 8,100 now at the end of 2,600, and a lot of people are on the same page.
You know, I'm of the mind that we will see an upward trending market in 2026, punctuated by periods of volatility. And the real rationale for that relates to this AI supercycle that you're pointing to. When we look at what we need to do for AI, it's not just a matter of seeing demand come through. Of course, we do want to see that. But when you look at estimates of where supply is for AI and data centers vis-a-vis where the demand is, there's still a massive mismatch, which makes it look like 2026 is still very much a CapEx, corporate spending, AI build year. And I think as that starts to come through, it undercuts what would be a normal business cycle. And I think it turns the attention from things like labor or inflation to what is happening to AI. I think all roads lead to AI in 2026.
So that's decidedly risk on. But Marta, what about the really risky stuff? Max Kettner of HSBC said that they are max risk. And it means that tactically they like things like small caps, unprofitable tech, high beta momentum. Are those bets you'd also take?
I don't know if I'd go that far. I think what still matters is where the earnings are. And what we're seeing with AI is right now, AI earnings are concentrated in the hyperscalers and incrementally spreading to other sectors. So something like small caps, I can't help. I mean, these are the lovable losers, right? They always drag down a portfolio, but their valuations are very incredible. So if you're looking for a broad portfolio that has a range of outcomes, I think valuations justify small caps. But are they going to be the main beneficiaries from this AI build in 2026? To me, the stars still align around the hyperscalers there.
Hey, Marta, what are the biggest risks that you think the market is underpricing right now? What are the things that keep you up at night?
Well, two things. One, I'm always concerned about the risk of a recession. There's a lot of credible voices that point to concerns around that, really starting and focusing in on the housing market, but then looking at the labor market. So I don't think we want to count that out as a possibility. It's certainly not my base case, but it's something that I watch. And then the other thing that I'm paying really close attention to are these moments of doubt that seem to gather around AI. When we take a look at AI and we look at this capacity build, we know that there's going to be long questions that emerge because we're looking at the long term, whether it's depreciation or circular financing or who the real winners are. And I think that creates some volatility, opportunities, but also some measure of risk.
Now, Marta, I got to say, everybody feels like they've completely written off a recession just quickly. If that's not priced into the market at all, I'm assuming it's not, just given all the bullish commentary we got. If there's a chance of that at all, how does that change how you're allocated for 2026?
Well, if there's a recession, I would imagine that there's also some measure of pullback in AI. And so that creates a lot of volatility for the market because, as we know, tech, 36% of S&P 500, it's hard not to have AI exposure at this time. So I think there are things that you can look to in the market at large to help protect. And one of those areas really showed up in November, and that was healthcare. It tends to be very defensive. It has had all these headwinds coming against it. And I think that makes it a little bit more appealing from a valuation perspective too. So I do think having that kind of wider landscape view to the extent that you can have it is something that's important for these portfolios.
Yeah, healthcare has underperformed the S&P this year, up 10% versus 16.5% for the entire index. Marta, thank you so much. Always great to get your thoughts. Marta Norton there from Empower. A quick check on your markets this morning. We're still looking at the highs of the day for the S&P 500, which isn't that much. We are, though, within 1% of all-time highs. Tech still doing poorly as two-year yields perk up. JOLTS data coming in. Those two-year yields up about 3 basis points. Coming up on the show, Ares unifies its global logistics real estate platform under one single brand. The company's co-head of real estate joins us next to discuss. We're going to hear from Julie Solomon after this break.
Let's get to high interest now. Look what's making headlines around the world. Deal makers say IPO preparation is intensifying as companies rush back after the shutdown and try to capitalize on near record markets. IPO volume is poised to blow past $40 billion this year, while Medline is pricing its IPO next week, one of the biggest debuts of the year. I think it's almost $5.5 billion. The biggest swing factor for next year is whether high-profile tech companies like SpaceX will pursue long-awaited IPOs. A new Lean In and McKinsey study shows women are leaning out of promotions for the first time in a decade. Interest in moving up has dropped across all career levels, with women now trailing men in ambition, a shift linked to companies rolling back DEI programs. Sheryl Sandberg says employers have changed, creating workplaces where women feel less supported. Sheryl Sandberg will join Bloomberg Television on the close today at 3:30.
I take problem with that.
p.m. New York time.
But framing it as it's the women's problems, I hope they ask her about that on the close.
Yeah, I don't know how you measure ambition, but we'll hear about it from Sheryl Sandberg and others on the close this afternoon. TPG has smashed its fundraising goals, pulling in over $6.2 billion for a new fund aimed at privately negotiated debt deals. The firm says demand is surging as companies face costly refinancing and looming maturities. TPG will craft highly structured loans tied to specific assets, a strategy it calls a win-win alternative to distressed investing. And that's not the first time the phrase win-win has been used on Wall Street.
Yeah, it's been used once before. By the way, we're going to stay in credit, and shares of Ares are trading higher this morning. The stock is set to join the S&P 500 on Thursday. A lot going on at the company. The company, Ares, also announcing that it's consolidating its global logistics real estate platform under a unified brand called Mark Logistics. Pleased to say that Julie Solomon, co-head of real estate at Ares, joins us now. Julie, we have a lot to talk about, but just starting with this, because clearly logistics is a sector that you like. What was the market signals that you're picking up on, deciding to unify it, and why exactly do that?
Well, thank you for having me here with you today. We are very excited and have even greater conviction today in the logistics market. And it's not new to Ares. I mean, Ares has transformed our real estate business over the past few years, building out one of the most scaled, vertically integrated managers across new economy sectors and one of the largest owner-operators and developers of logistics. And that really comes off of our conviction in the very large scale, very long-term demand drivers that we've seen, frankly, for decades now, but are now only accelerating by digitization and the way that consumer demand is focused so much on convenience and on speed. So for us, this is the natural next chapter of our evolution. It's to take our regional businesses that have been leaders in the market and now consolidating them under one brand so that we can better serve and be a landlord of choice amongst our clients.
So logistics, multifamily, self-storage, data centers, you've called them the new economy real assets. What makes all of these assets durable through perhaps a downturn, for example?
Sure. So Matt, what we see across these new economies is there's really two things happening here, which is there's very strong demand that's being driven by structural changes in the way that we live, the way that we work, the way we consume goods. And so those are accelerating, as we've been talking about, but it's also happening at a time in the broader real estate market where we've entered a recovery, and now we have values that have reset. Transaction volume has picked up. We're seeing positive valuation movement. And so we have a structural shift combined with the convergence of cyclical tailwinds. And what that presents for us is a set of opportunities in new economy sectors that are very interconnected.
What does that also mean is we're set to see a wave of refinancing in 2026? Sure. Rates are coming down, but they're still relatively high. Maybe options are more limited. Are there risks behind that as we start to hit these maturity walls?
We actually feel that at this point in time, particularly with rates coming down, stabilizing for the real estate industry, that's a benefit. And we think, though, that going forward, there will continue to be a gap in the marketplace to be able to fill in where we step in and provide that capital to help with those refinancing, to provide preferred equity, whether it's mezzanine or other forms of capital solutions. And because of the way we're set up, like the broader Ares platform with that capability of investing across the capital stack, we think it positions us for a very exciting year ahead.
Are investors underwriting across the spectrum now, or because we'd seen kind of a bifurcated market, right, where logistics was good, multifamily was good, yeah. You know, if you're housing students or senior citizens, okay, but everything else, no.
We are still seeing that bifurcation in the market. Now, broadly, the real estate market has felt more of a recovery across the different sectors, but there's still a bifurcation amongst the sectors and then within quality, within those property types where we're most focused. And so where our conviction comes from, it's really from experience. It's from decades of experience of knowing which markets to lean into, which to move back from, and what property types are going to be able to benefit from the durability of the trends that we're seeing.
Is office ever going to fully bounce back, or are we going to be working from home, 2 days a week for eternity?
Well, we at Ares firmly believe we're not going to be working from home in that capacity. What we see within the office space clearly suffered the most during the downturn. We've seen somewhat of a pull forward, but frankly, that's a sector where we see the most bifurcation. Ares has been historically underinvested in the office sector. It's not where we've been focusing in on the opportunity set. So we think we're going to be really careful as we look at what's ahead for us within the office segment, but not a primary focus for us at the present.
What are you seeing in New York City, whether it be office or multifamily? Because after the election of Mom Dani as mayor, there are all these grand projections. Oh, we're all going to leave New York. Things are going to be really bad. Has there actually been any signs of initial changes in the New York City real estate market?
There really hasn't yet, Dani. I mean, it's still early days, right? The mayor-elect hasn't been inaugurated yet. We haven't seen that pullback or change. We do believe that New York City exhibits some of the most attractive supply-demand fundamentals across markets in the U.S. We invest very selectively here in the local market, but we have a very big presence as a firm and fully believe that there's a lot of opportunity, and it's really a wait and see to see how the administration moves forward.
I'm always curious to know where people are going, though. I mean, maybe they're not leaving New York yet.
Or they did at one point, COVID, a lot of people left.
Right, and so multifamily is a huge focus for you, obviously, a very successful play there. Where is the highest quality, or where do people want to be?
Well, people want to be where it varies really by the population, because what we're seeing actually is within multifamily a much wider set of renters, right? We see a lot of renters by choice, where in the past it was more driven by affordability. But now a greater set of the population wants more flexibility, does want a more affordable option. So there are more places, but what we're very focused on are those markets that have strong population growth, that have strong employment centers, and that could present a more robust lifestyle for that renter population.
Can I just ask, because it's been a concentration of local governments and the federal governments, this question of affordability, and obviously housing plays into a big part of it. Because you know this space so intimately well, are there policy changes that could help? Is it up to the private sector to try to develop solutions for affordability? Has any city got it right?
Well, I think there are a lot of options for the private sector to help support the renter population. And particularly after what we've seen the last few years, where we had a lot of supply come into the market, but a lot of that supply has now been absorbed. I mean, last year we had almost 500,000 units absorbed, and that's creating more health within the market. And I think once you see that play through the rest of the real estate industry, the private market will be able to support that going forward.
Julie, it's been awesome having you here with us. I hope you join us again. Julie Solomon there of Ares Management. Still ahead, we'll get a check on the retail industry as Christmas approaches. Let's get a check on the markets right now. We are looking at an S&P that's up 0.1%, so not a lot of change here. As Paul Sweeney reminds me, the terminal used to say unch when we were trading in Steens. You can see the NASDAQ is down. We'll be back. This is Bloomberg. For the first time in 5 months, U.S. consumer sentiment is on the rise, right in time for holiday shopping season. Tanger Outlets has seen its stock rebound to close out 2025 and said its stores had lines out the door all Black Friday weekend. Joining us now is the CEO of Tanger, Stephen Yalof. Great to have you here on set. Let's talk a bit about Black Friday, how it went. I mean, there's always a lot of people, I imagine. That's when you go shopping. But was it better than last year?
It was. It was for the retailers, and I think it was for the shoppers too, because there was a lot of great sales this year, and that's what's bringing the shoppers in. You know, Black Friday is really, that's an outlet, that's a value shopper holiday, and that's why, you know, our sweet spot, we're in the outlet space, and that's why the customers seek us out for holidays like that.
And it's not a Black Friday, it's like a Black week, a Black month. Everyone loves to say, like, oh, it gets longer every year, but it genuinely is. The deals are starting so much sooner. Does that say something about the state of retailers and the desire to sell discounted goods, or is something else at play behind it?
Hang on, every day is Black Friday.
That's right. So that was our promotion this year, starting November 1st. Every day is Black Friday, and I don't think it's really a momentum builder. It's about building energy. It's about getting the consumer inside of your shopping center. Maybe one of their visits is a window shop. The next visit, they're actually going to go and buy things.
It's not, because one interpretation of this could be that the consumer is so weak, the only way you can get them to buy stuff is if things are discounted. So why not start this earlier? It's not that, is what you're saying.
Well, you know, I would think in our space, things are on sale every day. I just think you're not going to stand out online in the cold, waiting for your favorite store to open up, unless you're getting some kind of doorbuster prize, 2 for 1, buy one, get one free kind of programming. And that's really what Black Friday's evolved into, and that's what it's become. And, you know, I said this before to you, But unless you're on sale during Black Friday, you're not going to do the business.
And by the way, I've heard recently economists talk about Tanger as representative of a trend to move towards experiential shopping, right? I've got 2 little kids now. I'm not going to the outlet mall unless there's something for them to do as well. What are you guys doing to get people in?
Yeah, I mean, that's really been a big push for us from a strategic point of view. You know, the outlet shopping of 20 years ago has completely evolved. It used to be, you know, hit your favorite stores, get back in your car and go someplace for lunch. And you know, what we're finding is not only is our customer traveling to come to our centers, but they're also coming from a far more local, seeing a lot more local customers. So we're doing a lot of local programming. Our tree lightings this year were unbelievable. In fact, they were the best attended that we've had in the history of our company. I think a lot of that has to do with the fact that the customers moving to a lot of these geographies where our centers are positioned, but we're also doing a lot more to keep them there longer. Better restaurants, better food and beverage, better entertainment. You know, we program these centers and bring things like High School Battle of the Marching Bands, which is a super cool event. Yeah. You know, if you think about it, you get three high school marching bands on site. And they bring their kids, they bring their sisters, they bring their grandparents, they bring their families. That's a lot of people on site to watch these bands play. And to me, I think that's part of the pageantry and part of the celebration of the holiday season. These are things that we like to do, and we're doing across our portfolio.
In the latest University of Michigan Consumer Sentiment Survey, one of the interesting things was that the uptick was being led by millennials and Gen Zers. How are you seeing the younger generations, their behavior at the Tanger outlets versus, older generations?
We're seeing a lot of younger shoppers, and they shop together, which is really exciting. But, if we don't have the brands that the younger consumer wants, we're not going to be able to hold their attention very long, and we're certainly not going to get them back. So our leasing team has done an amazing job of bringing in these brands that they're looking for. Brands like Lululemon, American Eagle, which is a hot again.
Lululemon wasn't cool anymore. I thought it's all Viore and Aloe and whatever.
Trust me. Lululemon is still very cool, and when you can get it at 30 and 40% off, it becomes even cooler. And Gap is really cool again. I think Richard Dixon's done an unbelievable job with Zach Posen to make that brand really cool. The customers are seeking it out, and in our venues, it's available to them every day at a value price.
So how are you doing in terms of getting new clients in your locations, and also getting existing clients to sign up again, to re-sign?
Sure. So when you say clients, you're talking about the retailers.
Yes.
Because what's unique in the outlet business, we have both a shopper, that's our client, and we also have the retailer.
I'm talking about Richard Dixon.
Okay, great question. Well, it's interesting. The outlet pitch is such a great one. First of all, there's a lot of brands that have full price businesses. They have excess inventory, much like a Lululemon. And they're looking for a place to get rid of that excess inventory, for them to turn that excess inventory into cash, and they want to do it in a place where they can protect their product, they can protect the positioning of that product, and they want to do it in a lifestyle environment so that everything in the store is pretty much on brand and their product. So for us, that's an easy part of the sell. But the other side of that sell is simple. It's brands want to get in front of a consumer that they may not get in any other retail venue. So if there's a customer that just isn't shopping full price and their first introduction to the product is through the outlet channel, well, then it's up to that brand to own that customer, trade them up through their ecosystem, and get them into their fuller price product. And we see a lot of brands doing that too.
And you are, again, capturing on this trend that we've seen within earnings, that all of the discount retailers have done way better than ones that are not discount retailers. Given that and given that dynamic, are you seeing brands maybe look at you as more of a core strategy than a secondary strategy? Is their attitude around outlets shifting?
Well, if you take a look at the quality of brands that are coming into the outlet centers, then you would say yes. And in fact, there's some brands that are coming into outlets in categories that are new to outlets. Like Sephora is a really good example of a brand that's never been in the outlets before. Now, they might not be every product on sale every day, but they do have a promotional cadence in the stores. But more importantly, I think they see the traffic that's coming to the outlets, they see the customer that we're bringing, and they want to get their products out in front of that customer.
I'm just looking at your stock. The chart is incredible versus the Bloomberg REITs or Bloomberg Mall. You've outperformed all of them, and obviously you've trounced the S&P as well. Can you continue this kind of performance going forward? Because you're up 250% over the last 5 years.
Well, I think that there's still upside in our portfolio. We're a growth company. We continue to buy new shopping centers. We continue to re-merchandise those shopping centers. And I think, outlet especially is a specialty. There's a lot of barriers to entry to get into the outlet business, particularly on the marketing side, because it's really important for us as a company that we have a great marketing machine. A lot of brands are going to go and use their marketing capital to tell you to come to their full price business. It's our job to get the customers to come into their off-price business. So it's incumbent on us. And I think that muscle that we've built that's transferable, not only from outlet, but into that full price business, we've now since bought a handful of full price centers. I think that that's something that gives us an advantage as operators and owners of shopping centers.
Hey, Stephen, this has been so great. Thank you so much
Thanks
for joining us. Reminds me, I still haven't shopped for presents. I need to get out there. I need to get to Tanger Outlet. Stephen Yalof of Tanger this morning. All right, a quick check on your markets this morning. We're looking at still basically unched for the S&P and the NASDAQ 100. Yields are moving higher after the latest JOLTS data, up 2 basis points for your 2-year yield. Globally, yields have been moving higher, pressuring both U.S. bonds and U.S. equities, Matt.
All right, let's get a look at some of the single stock movers this morning. President Trump granting Nvidia permission to ship its H200 AI chips to China in exchange for a 25% surcharge. We kind of knew this was coming, so maybe there was a little buy the rumor, sell the news action here, but it's definitely getting sold this morning.
Yeah, and the fact that China says not so fast. By the way, Home Depot, they issued a cautious preliminary guidance for next year, saying high interest rates are keeping Americans on the sideline, but shares of Home Depot have turned around. They were deeply negative now, up just 0.2%. And
AutoZone reporting profits for the first quarter that missed estimates as a result of shares, despite my best efforts, down 4%.
Okay, coming up on the show, Paramount's hostile takeover bid for Warner Brothers brings together banks, billionaires, Middle Eastern sovereign wealth funds. We'll go over the players next. This is Bloomberg Open Interest. The names behind Paramount's hostile takeover bid for Warner Brothers are notable for as much as their size, as well as their proximity to President Trump. The investors include Saudi Arabia's PIF, the Qatar Investment Authority, and Jared Kushner's Affinity Partners. Joining us is senior deals reporter Michelle Davis. And Michelle, it's not just that you have these Middle Eastern sovereign wealth funds. The figure was they're giving something like $24 billion into this deal. That's more than double what we're seeing from the Ellisons. Just how much heft and influence are we getting from the Middle East and these investors coming into the Paramount deal?
A lot of it. I mean, it clearly seems like Paramount and the Ellisons are trying to use the Trump card here. They're showing, hey, we've got Trump's buddies lined up. We have all this financing. We have U.S. allies in the Middle East. And not only is, Larry Ellison one of the richest people on earth, but if he can't come up with the money, these people do. So that's what this whole argument hinges on for
And these
Paramount.
people, by the way, are coming up with a lot more money than Larry Ellison, right? Our reporting, maybe your reporting, pointed out that the Saudis, the Emiratis, the Qataris, they're all putting in a lot more money than the Ellison family.
And I think what's interesting about all of it is that if you read the filing, it does say that the Ellisons are and Redbird are technically backstopping it. So if anything falls through, they're saying, we're good for the money. You don't have to worry about it all being cobbled together. So they are on the hook for it, but they would prefer it if they didn't have to write a check for $60 billion.
By the way, be it Netflix or Paramount, all of these companies are going to be tapping the debt markets in a really big way to get this deal done. Does it say something about this time that you can have that? I mean, you could have EA earlier this year, that like the animal spirits are back. The fact that these things can happen in debt markets are free to absorb them.
Definitely. I mean, the banks are definitely open for business. When Warner Brothers and Netflix announced their deal on Friday, it came out that Wells Fargo had pledged to this massive bridge loan. They had pledged $30 billion on their own, which is the most any bank has ever pledged on a bridge loan. So that just shows the sky's the limit. Smaller banks, banks that hadn't been thought of as the big balance sheet banks like a JP Morgan, they're stepping up in Wells Fargo. And so, I mean, we know that there's just going to be more twists and turns on this. It's just a sign of the times, because this is also the biggest hostel ever that's ever been attempted. If it happens, TBD on, if they succeed, but if it does, it will just be legendary.
Yeah, wait, by the way, Apollo's in the Paramount deal, and there's a really, really good FT story out today that cited someone, an anonymous executive from Apollo, saying, we're basically a bank now and it sucks. But it just shows also those private capital players are able to participate in a way that like Wells Fargo traditionally would.
Yes, exactly. Yeah, Apollo has come in for the debt here as well. They have a partnership with Citigroup, and we see Citigroup also part of the Paramount Bank financing, so it makes sense that they're sharing some of that exposure.
All right, great reporting from you and the deals team. Michelle Davis talking to us about the hostile bid for Warner Brothers Discovery. We'll continue to keep you updated on that. Investors battered shares of Apple earlier this year as the iPhone maker faced repeated complaints about its lack of an AI strategy. But that has changed with the stock now outpacing Nvidia, the S&P, and the Bloomberg Mag 7 index. Let's discuss with Anurag Rana, senior tech analyst for Bloomberg Intelligence. And Anurag, it is interesting that now Apple is looking smart, considering everybody else has to lay out CapEx plans that sometimes top $100 billion in a year. But has this been planned, or did they just not figure it out?
See, this has been one of the taglines for Apple for some time. They are not in the business that they don't want to operate in, whether it's building data centers or search. They will partner with the best provider out there. Even if you go back a couple of years when they partnered with OpenAI, to us that wasn't a surprise, because that is what they're going to do. They're going to see who has the best large language model out there, and they're going to include that in their products. And that's something Mark Gurman has reported, that for the next version of Siri, they are working with Google to include one of their custom models for that. So they really don't want to be in certain businesses. They really don't want to be in certain businesses such as data center work. And we had put out a note a couple of weeks ago that when you look at Apple's CapEx going into next year, we have that going out at 3% of their revenue in 2026 compared to Microsoft, which is now running at about 40% of revenue. So they are on a very light model when it comes to capital expenditure, generate a lot of free cash flow and buy back shares. And that game is not changing for Apple anytime soon.
How much does this represent, though, Anurag, not just that model and the benefit of it, but a market that is now waking up to it? I point to CoreWeave, who yesterday sold off 2.3% because they announced a convertible bond sale of about $2 billion. This morning, they say, we're going to up that. It's actually going to be 2.25%, and they sell off again. Is this a market that increasingly will be punishing some of these big tech and AI-related names for the amount of debt they're taking on?
So at least in the last 12 months, I've seen this seesaw 3 or 4 times. There is a point of, let's say, 2 to 3 months when everybody is positive about it. Then you go into another phase when everybody gets negative about it. And we are in a phase right now that people are not comfortable with those level of investments. But, we don't know how that sentiment changes going into next year. One thing is for clear in our view, when it comes to capital expenditures that are made by the likes of Microsoft, Google, and Amazon, we feel very comfortable that even with that expansion, they have the products and the businesses to support that growth. Now, whether they decide to cut this expenditure down next year, that's another story altogether. But as of now, they have the backlog to support a lot of the fundings or the spending that they are doing.
I come at this story kind of from a personal perspective, as probably most of us do use iPhones and want the capabilities that we can access with ChatGPT or Gemini or any of the large language models. With Siri, how long is it going to be until I can say, hey, Siri, search my email for this, or hey, Siri, find me this flight, or hey, Siri, actually do something intelligent?
Yeah, I think that is the next big catalyst for Apple. And, I'll go by what Mark basically has reported on it is, sometime in the first half of next year, we should see that update come. But I also know this, I'm very confident that if it's not ready, Apple's not going to go out and release it, and they will wait for it. And that's really part of the hallmark of what Apple has built over the years is, going back to the fiasco of Maps multiple years ago, they really will not publish anything or go out with features if they are not 100% ready.
Though, is it a risk with Siri that they back the wrong horse? Like if they were to add ChatGPT and OpenAI to, and it turns out that Gemini is way better?
Right now, it seems that they are going with a localized model from Gemini into the background of Siri, and that's what's going to power it. The OpenAI relationship right now is when you are searching for that stuff, it actually sends that thing outside and goes to the cloud. The Siri integration is going to be a lot more within the ecosystem, you would expect that to search things within your phone. It's going to be on their private server, so it's a lot different than just sending searches outside to the from the ecosystem.
Hey, Anurag, thank you so much for this. That's Anurag Rana of Bloomberg Intelligence. Just want to note this crossing the terminal now. Silver is topping a record $60. All of this coming with investors assuming we're going to get rate cuts. It's much the same trend, Matt, that we've seen with gold, but this time just playing out through silver.
All right. Interesting look at the, I guess, sort of precious metal. Coming up, Europe's most powerful car dynasty is feeling the squeeze as Volkswagen's cash machine sputters. The Porsche Piech clan faces fresh pressure. We'll have this story next. This is Bloomberg Open Interest. As the financial situation at Volkswagen deteriorates, tension is rising among descendants of Ferdinand Porsche. For more, we're joined by Bloomberg's Monica Raymunt. She covers Volkswagen and Porsche for us out of Berlin. And Monica, I guess the tension here is that the Porsche Piech clan, they need to repay a big loan that was taken out in 2017. And so the concern is they're having to make a decision between paying dividends to fund that loan and the operating business of Volkswagen, right?
That's pretty much it, Matt. So basically what happened was one of the family scions, Hans-Michael Piech, he was forced to act really quickly when his brother decided to sell his stake in the family holding business. And in order to buy those shares from his brother, he had to take out some pretty sizable loans. And our reporting has shown that some of those loans are still in existence or were still in existence up until a few years ago and have added pressure, according to what we've heard, on the Piech family to basically get the dividends through the family holding company from VW.
Surely they could find a buyer for this, Monica, be it originally when the stake was looking at being sold, be it for the outstanding debt they still have. Why is Porsche going at it alone versus looking out there and seeing other partners or other options they might have?
So when that stake was up for grabs, when the brother Ferdinand Piech, who was a very combative former CEO at Volkswagen, when those shares came up, the family wanted to make sure that they stayed within the family and that they didn't sort of dilute their power or their control over Volkswagen. So Hans-Michael Piech was really on the spot to act quickly and to come up with the necessary funds in order to buy that stake and maintain control within the family dynasty. And so that's really what sort of drove that decision back in the day. Now that Ferdinand Piech is no longer really in the picture, the tensions between the Porsche side and the Piech side have really sort of died down. But that outstanding debt still exists. And the situation at Volkswagen and at Porsche right now, as within the entire German auto industry, is really putting pressure on the dividends that the family expects, in part to be able to pay off some of that debt.
Monica, when I started as a cub reporter in Frankfurt 25 years ago, Porsche was the most profitable car maker in the world, and it stayed that way for quite a long time. The Carrera T, which is essentially the base model to get into a stick-shift 911, starts at $153,000 before you had any options. Why is this company, which makes the most desired product on four wheels, having financial problems?
Oh, that's a can of worms there, Matt. There are many issues that Porsche is facing right now. Some of them are self-made, and some of them are structural. In China, if we start in the Volkswagen and Porsche's most important car market, Porsche has really struggled to sell cars there in the way that it has in the past, as the luxury market has really collapsed there, and consumers in China just really aren't interested in luxury EVs. And they made a big bet that that was going to be a different story in China. And now that that's not taking place, they've really had to downsize their business in China and look to other markets for growth. And when you look at the United States, on the other side, their second largest market, which has now become their largest market, they're facing major import tariffs. And that means that Porsche is really struggling, is going to really struggle for the next year or two to bring its margins and bring its profits back up.
All right, fantastic reporting. It's a great story, Monica. I recommend everyone read it. Monica Raymunt there in Bloomberg's Berlin office. Check out, by the way, my weekly podcast, Hot Pursuit with Hannah Elliott.